Kevin Simpson joins me now of Capital Wealth Planning. Thank you for joining us. You've trimmed some more. Like, I think you were with me last week and said you were trimming some. Now you're back trimming even more of Broadcom, but you did that ahead of the number.
Yeah, believe it or not, this is the second time this week that you and I have been talking about selling Broadcom, and we did do it ahead of the number yesterday. I think Stephanie covered it perfectly. And the diversification behind Broadcom is the reason that we love the stock, love the company. We still maintain a very small position in it, but we were digging deeper into the numbers. Their revenues were expected to be $38 billion previously. That got jumped up to $50 billion. So explosive growth, definitely nice things on the conference call about AI. And internally here, we said, well, what if they don't do 50 billion? What if they do 60 billion? Let's put an AI premium on it. And then we just broke it down to sales per share. And the float's been increasing a little bit over the past couple of years, so it comes out to about $130 per share in sales. And then we said, okay, let's take a ridiculous multiple. Let's take 10 times sales, and that gets you to a $1,300 share price. Historically, it's traded closer to 7 times, which is back at $900. Now, I agree with Joe and Stephanie that there should be an AI premium, but if you're talking 10 times forward sales of 60 billion, not even 50 that they're projecting with the street as in pretty much agreement, we're looking at a stock that's fairly priced. So for that reason, we've been exiting the position. Stephanie's point, up 51% in 3 months. I mean, when do I ever get a stock that gets to do that in our world? So we're taking some profits, and we're just taking a little risk off the table. Great company, just a little ahead of its skis.
You going to buy it back, perhaps, if it has a little bit more substantial pullback?
Absolutely.
The proceeds.
If it gets to 900, that's probably where it should be trading.
Yeah.
I mean, I would certainly be buying.
Oh, really? Okay. That's going to be an uncomfortable drop to watch.
Not for me. I sold it.
That's true. Good point. And you bought UNH. You bought UNH and IBM.
Yeah, you know, we're looking at IBM. So we talk about 10 times this projected sales number. IBM trades at under 3 times sales. Over the past 6 quarters, they've seen their free cash flow grow from $7 billion to $12 billion. We love free cash flow. We're getting over a 3% dividend. And with that type of free cash flow growth, we'd like to see the dividend growth a little bit. We'd like to see them grow that dividend a little bit behind it. But they're getting AI exposure through Red Hat, through Watson X. Let's face it, the stock didn't do anything for, what, 3, 4, 5 years? But the last quarterly numbers were excellent. We were adding to it ahead of that print. We think this is another way to be a little bit more old school tech, a little bit more value, conservative, dividend focused. But we like the growth story there for IBM. It's not the same IBM that it used to be. And we have tremendous optimism for this moving forward.
Appreciate it very much, Kev. Enjoy the weekend. We'll see you soon.